Welcome, everyone. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to be back with you again this Thursday, July 18th. We did miss last week. I apologize for that. There's a little technological issue, but we've gotten that fixed, so we're back with you this week. And I'm going to give you a nice recap of at least the way I saw things unfolding here over the past week. And I'm really going to concentrate on the last 5 days because it was last Thursday morning that we got a really big core CPI report out for the month of June. It showed that inflation was growing almost nil for the month, and our annual core rate dropped to 3.28%. And what this is now telling me, and what a lot of the signals in the stock market and bond market are telling me, is that there is a serious message being sent to the Fed that they need to begin lowering rates now. And I'm seeing money rotating in that fashion. In other words, Wall Street is beginning to accumulate stocks in areas of the market where we would normally see movement to the upside if, in fact, inflation's in check and we're going to get lower interest rates, which then hopefully will spur the economy down the road. So I'm going to start off with a recap from today, from Wednesday, July 17th. And this recap is for the last week. So again, it goes back 5 days to capture all 5 days since that inflation report came out. So on the screen, you'll see the IWM gained 9.31% in the last 5 days. That's not a misread. 9.31% for the small caps over the last 5 days. Transports up 6.44%, and mid caps up 5.06%. And then we've got the Dow 3.72%, and flipped and actually turning lower over the last week were the S&P 500, which was down just a little under 1%, and then the NASDAQ, which has lost over 4%. This is almost exactly opposite of what we've been used to in 2024 and even in 2023. Where we saw the NASDAQ outperforming everyone or all the other indices. Then we had the S&P 500. And toward the bottom, it's been transports and small caps. That changed. This last week, I'm telling you, this is a change in character for the market. And this is not what I think is just going to happen for a week or two. I think that the Russell 2000 is going to outperform the NASDAQ by a wide margin. Back in January, we had our Market 2024 event, Market Vision 2024. And I actually talked about this being the year of the small cap. I really thought the Fed was going to start cutting rates maybe in the second quarter. And I thought that would trigger a tsunami of buying in small caps. Well, the message that came last Thursday, in my opinion, was one where the markets are essentially demanding that the Fed start cutting rates. And we're even starting to hear a little bit of that talk now from the Fed. I don't know if they cut at the end of this month or not. They should. I don't know if they will. We're going to find out together here in the next couple of weeks. But in the meantime, I think what we're seeing in terms of the rotation is an expectation that we are going to see rates start to drop. And it's not just going to be one or two cuts. I think we're looking at a series of cuts that will go well into 2025. My opinion, of course. But anyway, this is, just looking at the numbers, but I want to show you the RRG chart on these same indices. And I want you to look at the IWM and where it is right now. This is the last 5 days. And you can see, if you talk to Julius de Kempenaar, who's the founder of the RRG charts, he will tell you that the real strength is when a stock or an ETF or whatever is moving on a relative basis strongly from the left side to the right side, moving in northeasterly fashion, which is exactly what we're seeing right here with the IWM, moving from improving into leading. It is now in the leading quadrant. And the fact that this tail is so long, that's telling us how powerful this move is to the upside. So if you look at the others, here's the mid cap. It's starting to gain strength, but it's still in the improving, hasn't quite gotten to leading. Here's transports, which for a few days was actually moving down into lagging. And then these last couple of days, all of a sudden, showing a lot of relative strength versus the S&P, also moving back toward that leading quadrant. Then we have the industrials, Dow Jones Industrials, which last couple of days we've moved back to all-time highs. Remember, we would hit 40,003 about a month ago, and then we pulled back and we really struggled. Well, the last 2 or 3 days, we've seen more strength coming into the Dow. It is beginning to lead, and it continues to set new all-time highs, which is great. QQQ, look on the other side, falling from leading into weakening and moving in southwesterly direction, which is the opposite of the IWM. And by the way, this is Max Payne week, options expiration. I refer to it as opposite George week. If you're a Seinfeld fan, then you know typically we start to see this type of movement anyway. Whatever wasn't working is working. Whatever was working isn't. But anyway, now we've got the QQQ pulling back. A lot of the stocks within the QQQ had a ton of net in the money call premium heading into this week. And that's part of the reason, in my opinion, why this group is lagging so badly. I think it could be something that lasts a little bit longer. I certainly see more troubles ahead later in the third quarter, but at least in the near term, I think options are having an impact here. But again, that kind of a strange, relationship where this is not what we're used to seeing. And just to kind of illustrate, I'll show you going back from the beginning of the year, you can kind of watch the IWM spending most of its time over on the left side of the RRG, occasionally showing a little bit of leadership. I mean, you can see there back in June, I mean, the small caps were just getting killed on a relative basis. And then we started to show a little bit more in momentum there. We're starting to move up. And then we started that northeasterly move back. This was probably about 2-3 weeks ago, made that move. And now look at where we are. So we have, we can stretch this tail back, say, 15 days. That's 3 weeks. Look at the path, the relative path that this IWM has taken over the last 3 weeks. Pretty impressive. All right, moving on. How about the sectors? What's been leading? Again, it's not the sexy groups like technology, communication services, those aggressive areas where we have, semiconductors, internet stocks, computer hardware like Apple. None of those. It's in real estate, financials. So we're seeing, specialty finance. We're seeing banks. We're seeing areas like that carrying the torch, taking the baton and now taking their turn in the sun and in the leadership. Energy, materials, industrials, healthcare, staples, utilities, all of these groups over the last week are green. What's not? Well, discretionary is exactly flat for the last week. Communication services, and then especially technology. And if I click on the technology here, whoops, that's not what I wanted. Oh, never mind. That's going to just take me to the chart. Sector summary. If you click on the technology, it'll give you each individual industry group. But I'm going to get to semiconductors in just a minute, so that's no big deal. Now, if I look at the XLK and look at some of the other sectors, just looking at performance, because one thing a lot of the analysts have been talking about is, this has just been driven by technology. Technology is the only sector. You've been hearing it over and over and over and over and over again. It's not exactly true. Yes, technology has been the relative leader, but on an absolute basis, there's a lot of other groups that still are performing well. So first, here's technology. You can see over the last, 3, maybe 5 trading days, technology's taken a pretty big move to the downside. Again, I'm not surprised. Heading into option expiration week, this is exactly what I look for after technology's been strong, because there's so many in the money call options out there. A lot of in the money call premium, net of in the money put premium. And as a result, it benefits market makers when prices drop this week. That's why this week is not a good week on just about every calendar month. And we'll talk about the history of this particular week in July a little bit later in the show. But XLK looks like, it's pulling back. That's good. Why? Because we're going to get strength coming in from other areas that have been lagging a little bit. How about the financials? Hey, welcome to the party. Financials moving up. You can see the last 7 trading days, but especially these last 5. What happened 5 days ago? Inflation. Remember? came out lower than expected, and just about everything in the market's been flipped on its head since then. A lot of these groups, all of a sudden, that would do well with rates coming down are starting to do well. Wall Street is moving into these areas, and that's what you need to take away from this. You know, everyone's so used to technology. Every time we get a little pullback in technology, I'm going to jump in. I'm going to jump in. That worked for about the last couple of years. That didn't work this week. If you keep jumping into technology when it starts a downtrend, it doesn't work out so well. You need to pay attention to this character change in the market. So XLF doing good. How about XLE breaking its downtrend? It's been in a downtrend. Went up, broke out, put in a higher low. Now it's back to new highs. So looks to me like we're trending up again in the XLE. XLI, breakout. I mean, again, you can say that a lot of stocks are not participating. I would disagree. Yeah. I mean, industrial stocks went sideways for a bit, but we're getting the breakout there. XLV, breakout. XLP, consumer staples, breakout on an absolute basis. Now, if you look down at the bottom, this is a relative chart. So yes, relative strength's been poor, but we're getting that breakout on an absolute basis, and that's a good thing. One last one, discretionary. Again, it went nowhere the last week, but it's actually broken out of late. And I still think this one could have some room to run to the upside. And you can see in July, relative strength really picking up on the XLY. All right, so semiconductors. I wrote an article over at Stockcharts. Go over to Stockcharts, click on the articles, and go in, look for mine. If there's a drop-down menu, you can pull up Trading Places, which shows all the, I normally publish here on the weekends. If you want to, hit this, type in your email address, hit that submit button, and then you can follow my blog. So anytime I publish an article, it'll be sent to your email. But anyway, a month ago, I drew this chart and I said, I think we've topped with that reversing candle. I thought we could go down 4,000 or 5,000 points on the Dow Jones US Semiconductor Index. And this is where we are now. I thought maybe 16,500, 17,000, something like that. Well, we closed the day at 18,500, down from 21. All of a sudden, 16,500 to 17 doesn't sound so far away. I think semiconductors are going to continue to struggle. We'll have some bounces from time to time, but I do think we have a very good chance of going back down into the 16,000s, which would not be good news for the QQQ. Anyway, this is one of the areas that's starting to flip, starting to look not so good. There are some economic things that are starting to look bad as well. And we've got a big event coming up on July 27th that I really think you should check up on. Take a look at our information and registration page. If you on the slide that you're looking at, there's a QR code. If you scan that QR code, it'll take you right to the registration page. This is a free event coming up on the 27th, and I'm going to be going over reasons why I think this is maybe just the start of something that could grow much deeper in terms of selling later in the third quarter. So I wanted to go through many of those economic reports, what I'm seeing there, because it's kind of lining up with some of the short-term topping signals that we're seeing right now in the market. So anyway, that would be something I think that most of you would probably enjoy checking out and enjoy attending. If you register and you can't make it on Saturday, July 27th, we do a recording and we send it out to everyone. So you'll still be able to check out the recording. All right. So we talked about semiconductors not doing well, but overall, I showed you many sectors that were. Here are industry groups over the last week that have shown the most relative strength for the S&P 500. Furnishings, the last 5 days have outperformed the S&P 500 by 16.45%. Now, we were downtrending relative to the S&P 500, and now we've started to turn back up. This is what it looks like on the chart. You can see the furnishings index coming back up here and moving back to above the 20-week EMA. And if you look, actually, I'll just pull up furnishings. But if you pull up furnishings, you can see, look at the last 5 days. Does this not look like a character change to you? I mean, we've been going down for the last 3 or 4 months, almost straight down. And then literally 5 days ago, we broke through the 20, and all of a sudden we're at a 3-month high. We're seeing a lot of this around many areas that were not performing particularly well before. We're starting to see some of that strength now starting to kick in. So that was one. I also wanted to show you, I think there was a couple of other industry groups. Let me take a look real quick. I know like healthcare providers, take a look at that. That's within the healthcare group. Look at this over the last 5 to 7 days. We've gone from being almost near a 52-week low to all of a sudden breaking out now to a 52-week high. So if you're looking at the market and seeing the S&P down and the NASDAQ getting killed, it's because all of a sudden many of those components within technology are turning down, but that money is rotating and you need to be aware of where this money is going. Okay. So what I did here is, and I want to show you one other chart before I show you a scan I ran. Here's another area. This is commercial vehicles. 5 days ago, we were trending down below our 20-day moving average. Now, what are we doing? Now, all of a sudden, we just had blast off. PPOs turned positive. We've had this big move to the upside. Look at the AD line ready to break out. I mean, we still got room to get, where we were, back in April. And yet we've got that AD line moving higher again. So here's the deal. I wanted to show you a scan that I did. So what I did is I went through and I took essentially the top 20 industry groups relative to the S&P 500 over the last 5 days, and I put them in a scan. So here are the groups, and I put them in here as OR. I put OR clauses in here so that when the scan engine looks at it, it can look at it and say, give me the stocks within furnishings or recreational products or home construction or business training or tires and so forth, all the way down for these 20 industry groups. And then I had other filters in here. I wanted to make sure individual stocks trade at least 250,000 shares a day on average over the last 50 days. I don't like the small stocks, so I'm adding the $5 filter. I want to make sure they're at least $5. And down here on the bottom, I added scooters have to be greater than 75. Why do I want scooters above 75? Because I want to get the relative strength, stocks within these groups that show some pretty good relative strength in their asset class. And by using market cap less than 10 billion, this focuses on the small caps. So small caps looking great, making the breakout. I wrote about small caps. I wrote about financials, banks, everything a week ago, talking about how they were setting up. That was before we had the 9% advance or the rest of the advance that we have seen on the small caps this week so far, and banks and all the other areas we've talked about. But this was a scan I ran, and I wanted to show you just a couple of charts real quick of the types of stocks that came back in the scan. So the first one I came up with was AIT. It was trending up, looked pretty good, sideways consolidating. Look at this, 2 equal highs. I'm going to annotate this chart for you real quick. So here are the highs coming across. Here are the rising lows. So what does that look like to you? It looks to me like uptrend, a continuation pattern. This is an ascending triangle pattern. And here is the breakout that then measures, this is roughly 202 down to about 177, 178. So roughly $25. So you break out at 202, measurement's 227. Right now, stock's sitting at 208. If it happens to fall back, gets closer down to the 202 level, I think that's best entry. All of a sudden, your reward to risk at that point really is solid. So that was just one of the stocks. But again, talk about character change. This is a stock that was going sideways for the last 2 or 3 months, not participating as the S&P 500 was going higher. But now all of a sudden, we've got small caps moving, and this is a stock AIT making a breakout. And it's in the industrial suppliers area, which was one of those top 20 industry groups. Here's the second one I wanted to show you. This is Lazy Boy. This gap up that we saw back on June 18th, that was earnings. So the company came out with great earnings, gapped up, pulled back basically to its 20-day moving average, turned up, and with these last, since that inflation report came out in the morning of last Thursday, you can see big breakout here, 5 days in a row going higher, making this breakout above 41. And that was a big level because that was a top after great earnings came out. So after coming back, now we've broken out. I think Lazy Boy's poised to go higher. Pull back into that maybe 40.5, 41 level would probably be best entry if it did pull back into that area. Maybe it gets back down to the 20-day. I'm not sure if we'll go down that much. But again, this is just two examples of stocks that have kind of changed their character as a result of what we saw with inflation and the demands that the market is now making on the Fed to lower rates. I think the way I would look at it before, it was like the market was requesting it and has been requesting. There is no doubt money flowed into the areas which now is saying, Fed, you're lowering rates. Just stop this game. Let's start lowering. They should cut rates, I think, coming up in 2 weeks, end of July. I don't know if they will. They'll probably talk more about rate cutting at the September meeting. I think they're going to talk about, hey, we're starting to see more and more signs that the sustainability of that move in inflation is to the downside, and that barring any kind of unforeseen events, we're looking at cutting in September. That's what I think they're going to say and do, which I'm not sure is enough. I think they should be cutting right now. I don't know why they need to wait another 2 months to decide that then it's okay to start cutting. But again, you're just getting my opinion here. All right, I think that is about it. I do want to show you how you can reach out to us at EarningsBeats. So on the slide, you'll have another QR code. If you scan that, you'll come into a landing page where we will show you how you can sign up for our EarningsBeats Digest, how you can connect with us on YouTube, and so forth. So it's a great way to follow us in other areas. Make sure you understand where you can reach out to us. All right. I think that's a wrap for today's show. I do want to just let you know, first of all, there are significant short-term warning signs right now. I think what's going to happen is I think the market's going to continue to struggle here while we work our way through options expiration, maybe into next week. I think maybe we have one more move up. Maybe it coincides with some of the earnings reports that are going to be coming out. And then I think later in the third quarter, we're going to be going down. But in the very short term, you've got a positive correlation with the VIX and the S&P 500. If you pull that up on a daily basis, you'll see that correlation has turned positive. That doesn't happen very often, and it usually coincides with a reversal in the market. That's number one. Number two, we've got the 5-day moving average of the put-call ratio. It hit 0.54. If you pull that up long-term, you will see that there have been a number of instances when we get to that level, because that's telling us that there are a lot of folks getting very bullish in the options world. That's normally when the carpet gets pulled out and we pull back. So that's number two. Number three, I talked about Max Payne. Options expiring Friday. The Monday after options expiration historically is the worst day of the trading month. That's coming up on Monday. And then finally, historically, the week that we are now starting at the close on July 17th, which is today, through the close on the 24th next week, this is the third worst week of the year. Trails only October, which has the number one worst week, and then in September, the second worst week of the year. This is the third worst week of the year. It started today at the close, which adds to the potential bearishness. Again, none of these things guarantee me or anyone else the market's going lower. It simply tells us that we have some risk at hand. So please be careful out there. Continue to follow us over at EarningsBeats. We'll try to keep you, in the clear as best we can, and we'll take it week by week. I will see you next week. Have a great week until then, and happy trading, everybody.